Hey everybody, just wanted to put out a little bit of a note. First of all, big Black Friday sale coming up. There's a waiting list. You can check it out at crushthepremium.com/training. And today I wanted to talk about SOXL. I just put out a tweet about how these leveraged and really inverse products work. I've been talking about this for a long time. A couple months ago, I put out the math behind how this works. Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. And people continue to play these things. Why? Well, because they give you those nice, juicy premiums, and they're fun to play, and they give you big wins in a relatively short amount of time. But as folks who've done my programs have learned, that quality aspect of what you're trading is very, very important because all roads lead back to the underlying. I don't care. These are derivatives. They derive their value from the price of, guess what? A stock, which is, guess what? A company, which is what you are exposed to in the end. So how does this work? Well, let's take a look at it one more time here. So let's say on day one, you're trading SOXL, which is multi-levered to semiconductors. Number one day, $100, and it moves up 5% to 105. What do I? Well, it goes from 100 to 115, right? It's 3 times the 5% in theory. It may not work exactly like that, but in theory, and it should very much happen because they rebalance every day, and they want to make sure that the daily performance, this is the key to these, daily performance is what is key to them. Over time, they cannot control things so much, but the daily performance is their number one priority. So SOXL goes from 100 to 115, which is 3 times the 5% gain of the semiconductors. Day number 2, I've used this number here. They go down 4.762%. Why do I say that? Because that gets us right back to $100. I wanted to find out exactly what it takes to get us right back to square one where we started. Well, what does the SOXL do? It goes from 115 down 4.762%, it falls $16.43 roughly. And that's 4.762, which is what the underlying index it's based on, moved 3 times that amount, which ends up being $16.43 to 98.57. So let's look at what happens here. The semi index is back to where it started at $100, but the SOXL is down 1.43%. Okay, so this is a big move, you're saying. Oh, what's going to move 5%? These things move all over the place. And I'm merely using a larger daily move to illustrate what happens here. It's going to happen on a 2% move. It's going to happen on a 3% move, a 1% move. This math holds for any kind of move. So what does that mean? It means that the SOXL is short realized volatility. Realized volatility is actual volatility, right? Actual volatility is what we see happen in the market every day. And when you are short realized volatility, you get hurt. Just like if you're short an option, it moves against you, you can get hurt exponentially, right? You can sell something for $1 that could be worth $20 the next day. You are short leverage. In a similar sense, you are short realized volatility here, which is going to hurt you. So imagine that this happens every day. So we get a couple of days up, we get a couple of days down, we get a giant move up one day, giant move down. Well, guess what? We don't have to imagine very much because that's happening over the last few months. So what does that mean? What does that equate to in the real world? Well, let's take a look here. Okay, so we've got the charts here. We can look at SMH. So SMH, we can see is down to 240. It's kind of breaking down below here, which is a little bit concerning to me. And that's why we've been getting out of these things in the community. But the point of this video today is to really talk about the difference in performance. So we've got SMH back to where it was trading roughly, what is that? Maybe like October 5th, 4th, something like that. Let's take a look at where the SOXL is by comparison. It is right here. Look at that difference in performance. We have got the SOXL back to where it was trading in early September, so September 9th or 8th, something like that. So look at the difference. We have got an SMH that is probably 11, 12% above where it was at the time SOXL was at the same level last time, right? So basically that's your outperformance. The SMH is outperforming drastically over the SOXL. And the reason for that is this chop, this leverage decay has really kind of hurt performance. As long as you get things kind of chopping around like this, look at all this chop in here. We've got massive chop here. Here, leverage products can be okay. You get sort of that nice steady performance. That's where it's actually going to work in your favor. In here, not too bad as well. You've got a few little spots here where it's maybe going to get chopped just a tiny little bit. But look at this. We have got big time chop. And then, of course, this big, massive dip here. This is what is contributing to a complete collapse in relative performance. Look at one versus the other. Right here, sorry, just getting used to my my little pen program here. Here's your performance of SOXL versus the SMH. So this is basically everything in a nutshell right here. You've got this amazing underperformance as it reaches the lows that we saw in August when we had this massive downdraft in the AI trade. The semiconductors sold off very, very hard. And we've basically given back all the bounce, right? We got back up into a reasonable level, I guess, of bounce. And it ended up being something that failed a couple times, and it's failing quite in a large way right now. And so what really concerns me in the sector is that you really have it kind of reminds me a little of this period here. Now, NVIDIA earnings are coming, and we hope that they save the day and swoop in and take care of things. But we got to really hold this 200-day. I'm a little bit worried about this. We've seen a lot of wreckage in the semiconductor area. We've seen good stocks, AMD, Micron never really recovered a ton. AMD, good one, breaking down. AVG, Broadcom not doing that great. SMCI, a complete and utter train wreck. ASML, used to be one of my favorite stocks. It's unfortunately really succumbing to perhaps what's going on geopolitically and politically really. And so we saw a big downturn in orders there. So there's some things to be concerned about here. I mean, NVIDIA just has good things to say about semiconductors. So it really comes down to NVIDIA, last man standing. And for me, we got out of everything a couple days ago. It just wasn't looking as good anymore. So hopefully that kind of explains the math to it, you guys. And I'm not saying don't trade these things, but be very aware of what you're trading. It kind of irks me that people push this stuff all the time on Twitter and social media. Hey, look, so I'm doing this and that. And they may be pushing newbies into these products. And that's why every few months I come out and give people the math and let them understand how the structure of these products actually works. They have to kind of rebalance in order to get that next day's performance as advertised. But the problem with that is as you rebalance, as the stock goes up, you rebalance, and when it comes down, you've overbalanced for a sell-off, and then vice versa. When it comes down, you're getting out, but then you're really kind of compounding the mathematical issue from the structure of these things. So they are really not meant for a long term of holds. They're meant for kind of tactical moves in and out. And then once you add derivatives to them, yes, you get that extra bit of premium, but there are some obvious problems going on here. So be aware of what you're trading at all times, especially 3 times levered are going to suffer from this particular problem even more than a double time, than a 2 time. Okay, so hopefully you guys learned a little something there, and we'll see you in the next video.